Are we headed for a market crash? Are we in a housing bubble? These are questions you might be asking yourself and your family over the last several months, looking at the current real estate market. I thought this would be a great opportunity to make a video in order to discuss and outline some of the things that suggest that we might not be headed for a crash and what's different now compared to the crash of 2008. If you're new to this channel, please allow me to introduce myself. My name is John Sintich. I'm your go-to realtor in the Chicagoland area, and I'm here to provide some educational real estate content for my viewers and subscribers. If you find this video informative, please like this video and subscribe to my channel. I am a licensed realtor in the state of Illinois. I do work for a company called eXp. So if you're interested in buying or selling, feel free to reach out and I can help you strategize. All right, let's get rolling. The warning signs look all too familiar. Looking back to 2008 and what happened and comparing it to now is imperative to understanding where we're headed, okay? So escalating home prices have both buyers and sellers worried that the market is just too good to be true, right? And agents across the United States are getting bombarded with this ultimate question. Are we in a housing bubble? Let's look at three key factors that suggest that we're not, so that you can navigate this market with more confidence and decisiveness, okay? Factor number one, okay, housing supply. Last year, home values appreciated 15 to 20% across the country. This year's growth isn't expected to match it, although some indicators and some experts are now predicting that it might match or even exceed that. Buyers and sellers are worried, they're still worried, that home prices are too high and that depreciation is likely to follow soon. However, unlike the housing bubble years of the mid-2000s, the major factor driving up home values is we're also seeing a crazy inventory shortage. A balanced real estate market inventory sits around 6 months supply. Today's current market is at 1.7 months nationally. This is historically low. So what's different about today's inventory issues to the inventory issues of the years leading up to the crash? Let's look at that. I'm going to show you a little graph that'll kind of explain it. The inventory level from 2005 and 2007 leading up to the crash, right? So the years leading up to the crash, from 05 to 07, the inventory of available homes for sale increased from 5 months to 11 months of available homes for sale. When you go from 5 months to 11 months of available homes for sale, you're in a buyer's market, okay? Why are the prices of homes going up so fast and so high in a buyer's market? You start to see why these numbers can be construed as, artificial. So why in a buyer's market are home prices continuing to go up and up and up? You can understand that the term artificial can be applied to those prices. So let's throw it back to what we learned in high school economics class. The biggest driver of price appreciation is a simple case of supply and demand, hence what we're seeing in the market today. Let's look at factor number two, housing demand. I'll be completely honest. I'm 29 years old. I was a sophomore in high school in 2008 when the market crashed, and I was in my adolescent years during the real estate insanity that was occurring in the marketplace in the few years leading up to the crash. However, I'm a nerd, and if you want to be a good realtor, you need to study the past to understand the future. So I spent a lot of time reviewing data from those years so that I can offer an educated perspective here. So going back and reviewing data and from the expert insights that I've reviewed, the general consensus is this. The buying and selling frenzy that contributed to the market collapse in 2008 was fueled not by tactful financial decisions, but by a countrywide case of FOMO, fear of missing out. I'm sure everyone knows what that means. If you don't, you missed the boat on that. That's an old one. The mortgage industry fed into the frenzy, right? Making it easy, super easy for people to obtain home loans much higher than they can even afford. So we had very irresponsible lending standards back then. This is much different now. If you've spoken with me at a party about real estate, or you've ever met me and talked real estate with me, or you've had a buyer-seller consultation with me, you've probably heard me talk about this ad nauseum. The lending standards today are much more strict than they were back then leading up to the crash. Plus, with escalating rent happening across the United States, many Americans are opting for the financial stability that home ownership offers, okay? These factors are also coupled with low mortgage rates. We're starting to see interest rates go up But let's look at the current interest rates in relation to historical data. I'm going to show you a graph from Freddie Mac that kind of displays the rise and fall and rise of interest rates over the last several decades. If you're looking at the graph, you can see historically rates are still very low. I mean, we're going up to close to 5% here, but that is historically low in relation to the past decades. So again, the rates are going up, but you're not going to see a ton of people exit the market because the rates are going up a little. Historically, they're still very low. You might see a house that has 30 offers on it. Now they're only going to get 5 offers. That's still very much a seller's market. Okay, let's look at factor number 3, equity. Following the housing and economic crash of 2008, economists, financiers, and real estate industry experts have combed through the data to figure out why the entire system crumbled the way it did. And I took the time to kind of research all of that information that's been compiled into very easily digestible, blogs and articles and what have you. So from reading these and combing through the data, most will agree that one of the biggest pieces of that catastrophic equation came down to equity, or lack thereof. The mid-2000s saw a massive wave of homeowners cashing out the equity in their homes. Basically, they were using their homes like ATM machines to cash out, refi, and buy a car or buy, a vacation. They were using the equity in their home for frivolous material possessions and not reinvesting it to build more wealth. So people were making silly financial decisions, for lack of a better word, based off their home's value. Very irresponsible. So this led to a big uptick in foreclosures and short sales following depreciating home values nationwide. Today, we're seeing a much different situation play out. Cash out refinance volume over the last 3 years is less than a third of what it was compared to the 3 years before the crash in 2008, okay? Plus, escalating appreciation meant that homeowners gained an average of $55,000 in equity over the last 12 months alone in America. As prices continue to rise, equity is going to rise as well. The equity situation is just not even close to the same as it was back in 2008. This positive equity perspective puts the current housing market in a much stronger place, and it minimizes the risk of a wave of foreclosures coming. Let me end by saying this. Nobody has a crystal ball. Nobody can tell you with 100% certainty what's going to happen 5-10 years down the line in the real estate market. All we can really rely on is the data and the facts. And at the end of the day, knowledge is the most powerful tool that you have. So use the knowledge that you've gained from this video to help you make the decision that is correct and right for you. All we can do is look at the facts and the data. Just saying we're in a housing bubble, prices are way too high, it's going to crash, without actually, digging into the research on why that is and comparing it to what led up to the crash in 2008, what was causing, those insane home prices leading up to 2008. And what's causing them now. They're completely different. It's important to know why. That's it. So once you have a better understanding of why prices are where they are, it should give you confidence to move forward with your decision making in what you're going to do with your real estate goals. The goal of this video is not to tell you buy a house right now or sell a house right now or don't buy a house right now. It's to give you information so that you can decide what's best for you. So I hope this video did that for you. I hope this video was helpful. I hope it was enjoyable. I hope this video resonated with you. If it did, send it to a friend. Share it on your social media. Like the video and subscribe to my channel. I am a licensed realtor in the state of Illinois, so if you need help buying or selling, feel free to reach out to me anytime. My contact information is below in the description. Thanks for watching, guys. I appreciate you. Have a great rest of your day.